Welcome to GRE. I'm your host, Keith Weinhold. Should billionaires even exist? Why do so many people think that interest rates of all types are headed even lower? Then, as a real estate investor, how to identify and capitalize on an opportunity in this era? It's something that I've never seen before. Today on Get Rich Education.
Since 2014, the powerful Get Rich Education podcast has created more passive income for people than nearly any other show in the world. This show teaches you how to earn strong returns from passive real estate investing in the best markets without losing your time being a flipper or landlord. Show host Keith Weinhold writes for both Forbes and Rich Dad Advisors and delivers a new show every week. Since 2014, there's been millions of listener downloads in 188 world nations. He has A-list show guests include top-selling personal finance author Robert Kiyosaki. Get Rich Education can be heard on every podcast platform, plus it has its own dedicated Apple and Android listener phone apps. Build wealth on the go with the Get Rich Education podcast. Sign up now for the Get Rich Education podcast or visit GetRichEducation.com.
You're listening to the show that has created more financial freedom than nearly any show in the world. This is Get Rich Education.
Welcome to GRE, from Flatiron, Manhattan to Flatbush, Brooklyn, across New York City and 188 world nations. This is Get Rich Education. I'm your host, Keith Weinhold. It's the longest federal government shutdown in U.S. history. This whole thing has now lasted longer than most gym memberships. I guess the GDP stands for government doesn't produce. Before we get into our core investing and real estate content today, Billie Eilish, the singer, recently made some public remarks on whether or not billionaires should even exist. Yeah, now, if you're not familiar with her, Billie Eilish is known for her kind of unique style, sort of these baggy clothes, neon hair, avant-garde fashion, and she has a reputation for being outspoken about a lot of things like mental health and body image and environmental issues. Now, in general, I respect people for speaking their mind, whether I agree or not, because a lot of people are just afraid to do that. Let's listen in to this short clip on what she said. You might have heard this because it was pretty widely broadcasted. Eilish spoke after receiving recognition at the Wall Street Journal Innovator Awards. This is courtesy of the AP, and then I'll come back to comment.
We're in a time right now where the world is really, really bad and really dark, and people need empathy and help more than kind of ever, especially in our country. And I'd say if you have money, it would be great to use it for good things and maybe give it to some people that need it. And love you all, but there's a few people in here that have a lot more money than me. And if you're a billionaire, why are you a billionaire? No hate, but yeah, give your money away, shorties. Love you guys. Thank you so much.
First of all, without explicitly saying it, she's basically referencing how inflation widened the canyon between the haves and the have-nots, and GRE listeners that have acted have been on the right side of that canyon. I actually want to give Billie Eilish some credit here. Giving is virtuous. That is a good thing. In fact, next month I plan to discuss the pros and cons of giving here on the show as we approach Christmas. Billie Eilish, she's certainly not a hypocrite either, because she's given away more than $10 million of her estimated $50 million net worth. She's into feeding people and climate initiatives. That right there is giving away more than 20% of your net worth, and that is really kind. Now, you heard her say, there's a few people in here that have a lot more money than me, and she's right. Mark Zuckerberg was in that room. His net worth of over $200 billion means that his net worth is more than 4,000 times greater than Billie Eilish's. It sounds loosely like she's shaming him for not giving away more of his wealth. And I don't know just offhand how much Zuck gives away, but this is where my credit to Billie Eilish stops. I think that it's okay for a person to be a billionaire. I wouldn't question that. I mean, a lot of times it meant that that person was willing to take risks that others would not dare try. A billionaire probably means you're a person of great value and that you've hired hundreds or thousands of other people, creating jobs for them. A billionaire has almost certainly created a product that society values. Jeff Bezos pioneered one-day delivery. Zuckerberg connects people through his Meta platforms. And I'm not going to say that either one of those billionaires are perfect people. They are flawed just like you and I. Billionaires probably pay more tax than the average person as well. That supports the infrastructure that you and I and everybody use, like building bridges or creating a fiber optic network. I would expect that a billionaire would be a giver as well. And see, if you're a billionaire, you have more ability to give than the average person does. You can make a greater impact. And see, this is where things really break down and not make sense. So if Billie Eilish's net worth is $50 million, apparently that's just okay. That's fine with her. But once it gets to 20 times greater than that, which is $1 billion, then it's not okay. So that means the line is drawn somewhere in there. That makes zero sense to me. The ceiling on what you're supposed to have in net worth is between 50 million and 1 billion. Like, I really do not get the logic on that one. And, a guest that we've had on the show here, Grant Cardone, whether you like him or not, he has had some on-point remarks about these Billie Eilish comments himself. To the question that she posited, which is, if you're a billionaire, why are you a billionaire? Cardone's answer is, if you're a pop star, why are you a pop star? Billie said, give your money away. Cardone's response to her is, give your music away. That's some food for thought there. That's my take on the Billie Eilish remarks on whether or not billionaires should exist. And if you want to hear Grant Cardone and I's conversation here on GRE, that was episode 264. The title of it is Keith Weinhold and Grant Cardone, 10X Your Wealth, number 264. A lot of listeners like that episode, saying something like it was a dream to hear Grant and I together for the first time like that, their favorite sales trainer on their favorite real estate show. You can listen by either scrolling way back to Get Rich Education episode 264 in your podcatcher, or you can listen directly by going to getricheducation.com/264. Now, the Fed has said that they are going to slow or end QT next month. All right, when Jerome Powell says something like this, what does that really mean to you as an investor? What can you expect? Ending QT. Well, you probably already know that QE, quantitative easing, that has the effect of creating dollars. QT is the opposite. It has the effect of destroying dollars. So if they're ending QT, this helps keep more dollars around in the future. So ending QT then, like we expect soon, that really parallels a lower interest rate environment. Because see, lower rates already make dollars flow more freely. You probably remember the analogy that I introduced to you on the show earlier this year about how lower rates are like lowering the height of a dam wall. It makes it easier for water to flow, so then lowering rates makes it easier for money to flow. And that's because low savings account rates make people get money out of those vehicles. Okay, that's that low dam wall. And low borrowing rates make that money flow as well. People will unlock dollars if rates are low. Late last year, the Fed dropped rates a full 1%. Then they didn't make any moves for a while until late this year. They've now dropped rates another 0.5%. That's the environment that we're in. So then, more QE and less QT, that further eases the flow of dollars, and it correlates with even lower rates that are coming in the future. Now, it doesn't mean that they will. I'm not saying that they certainly will. There is just that tendency, that correlation. So we had pandemic-era QE there about 5 years ago. That ended as we moved to QT in 2022. And now what we're doing is unwinding QT, moving back toward more flow. And it surely gets more technical than that. Ending QT allows the Fed to expand its balance sheet again. Treasuries and mortgage-backed securities, once matured, can now be replaced. And that injects liquidity into the system once again. And that is where we're going. Bank reserves are reaching ample levels again, and there is no need to put liquidity stress on money markets. A lot of these moves are here. What they're here for is to help ease the concerning labor market. It's been almost exactly 3 years now since ChatGPT launched. And a while back, I mentioned how companies were newly interested in hiring the shiny new job that didn't exist before, the AI prompt engineer. That was one of the hottest jobs. Well, yeah, that was true back in 2023, but not so much now. A lot of companies have figured out that the employees that wanted to keep their job, well, they figured out real quick how to be the Ask AI good questions guy. And we are seeing more layoffs. Later today, my guest and I will talk about that. And also, he's going to make somewhat of a future mortgage rate forecast, or at least talk about the direction that they're going in. I think you're really going to like that. I don't predict rates myself, but sometimes a guest will. That's what's happening today. My point here is that with QT ending, which again lowers the dam wall height and eases the flow of money, that parallels the fact that we have lower interest rates now than what we had 1 year ago, and we have lower interest rates now than what we had 2 years ago as well. Be mindful that you cannot get it all as a real estate investor. You cannot get soaring employment and low interest rates together. You cannot get those two things together, at least not for long. High employment means high rates. Low employment means low rates. Today's guest and I will get into that as well. Well, as we've had lower rates, hence a lower wall height, don't buy property and expect that you'll be able to refi into a lower rate within a year. If it happens, great. Don't buy expecting rents to go up or rates to go down, although many think that will happen. Just enjoy it if it does. Rent vesting has been on the rise lately. Yes, rent vesting. What that means is when you pay rent in the property where you live, and then the only properties that you own are rental properties. Rent vesting makes sense if you live in California, New York City, and Boston, since rent-to-price ratios are so low there. And then you invest your dollars inland. That's how you can live in a high-cost place and yet still benefit from cheap rental property and have income streams from them. You might remember that some months ago, I interviewed 2 listener guests on the show, everyday listeners just like you, and California-based investor and GRE listener Joshua Fang told us about his rent vesting. He pays rent in his primary residence, since the rent-to-price ratio might be 0.3% there, and then he owns property in GRE marketplace markets. I think it was Memphis and elsewhere, where you're benefiting from, say, 0.8%. That is called rent vesting, investing in properties that make sense that you buy through GRE marketplace. And remember when Josh told us that passive income gives him time to enjoy life and even stop and watch 2 lizards for 15 minutes? Oh, what passive income can do. It's the quirky things that you remember. See, the point is that smart people in high-cost states are rent vesting. If that's what you've got to do in order to own real assets, then do it. Get on the right side as this difference between the haves and the have-nots just keeps expanding. I just did something that you might find interesting. Over the weekend, for the first time in years, I visited that first fourplex building that I ever owned, which is also the first piece of real estate that I ever owned. That blue-colored fourplex, and it is still blue. The address of that property is 925 East 45th Court, and it's in Midtown Anchorage. It has never been a pretty neighborhood, and I confirmed that it still is not. It looks a touch worse than when I owned it. I straightened up the curb appeal more than today's owner does. I bought the fourplex over 20 years ago for $295,000. And at that time, on the day that I bought, the total rents were $2,900 because it was $725 per door. I just looked on Zillow, and do you want to guess at its zestimated value today? Yes, it cost $295K back in 2002, and today the zestimate is $625K. I don't know what today's rents are. My guess is that they're just short of $6,000 for all 4 units combined. 2-bed, 1-bath, 960 square foot units, really plain, vanilla, boring looking housing. But it's certainly not like a crime-ridden slum. It's just a depressing-looking block that's just chock full of disorder and these other fourplex buildings and dumpsters all over the place. But yeah, that's how it all began for me. I visited that building again, and I haven't owned it in a while. I 1031 exchanged out of it and into an 8-plex in 2013. If it weren't for that building, you would not be listening to me right now, and you would not have heard of me because this show wouldn't exist. Big thanks to the 3.5% down FHA loan for someone that came from humble means like me. Last month, I did a running race that goes up a ski jump. That was pretty cool. It gets so steep that you have to grab onto a cargo net to pull yourself up. It's almost like a rope ladder. I did not win. I got 5th out of 21 competitors in that race. Yeah, I like to get out and physically challenge myself after talking real estate all day. My body weight is up a little. It's currently sitting at 178 pounds. That's 81 kilograms for our European listeners. And it hit its recent bottom of 172 back on the 4th of July. That's by design. I need to be really leaned out for a big Independence Day race every summer. You know, I'm one of those guys where I still cannot compete with bodybuilders because I'm too lean, and yet I don't win running races because I'm too bulky. So I'm more of an all-around guy. I do about 7 different sports, and that's exactly how I win nothing and always get like 5th place or worse. This major mammal has got to keep himself moving in any case. Next week here on the show, we'll talk to a Harvard grad. She's super interesting. She used to work at Apple, and then she founded an AI-centric property management company so that you can use her platform to self-manage and leverage AI. But are we at the point where your tenant would really talk to a chatbot? Would that fly? And if society is there, well then, do property management fees and everything start trending towards zero? I'm going to ask her about that. That's next week. As for today, you know, the World Series ended about a week ago, and what I did is that I watched 10 commercials during the World Series, and then I jotted down the name of each sponsor. And here's who the World Series advertisers were just in this one segment where I paid attention to them. They're all big brands that you've heard of. AT&T, Liberty Mutual, Nature Made brand items like vitamins and supplements, Starbucks, Coors Light, Qdoba, Capital One, Home Depot, Crest White Strips, and Jim Beam. All right, those were the 10. What do those 10 have in common, more or less? Any ideas there? Those 10 products and companies are all for consumer products. That's the common link. And that might seem so obvious that you wouldn't even think of it. Well, this is because most ads are for consumer products. Those ads fuel consumerism, and there's nothing wrong with that at all. That represents an economy. In fact, I use some of those very companies in my personal life. But here's the difference. Here at GRE, our sponsors help you produce, not consume. Think about that as you listen to me in this spot for Freedom Family Investments and then Ridge Lending Group. Then I'm coming back for more with a terrific guest. You know, most people think they're playing it safe with their liquid money, but they're actually losing. Savings accounts and bonds don't keep up when true inflation eats 6 or 7% of your wealth every single year. I invest my liquidity with FFI, Freedom Family Investments, in their flagship program. Why? Fixed 10 to 12% returns have been predictable and paid quarterly. There's real-world security backed by needs-based real estate like affordable housing, senior living, and healthcare. Ask about the Freedom Flagship Program when you speak to a Freedom Coach there. And that's just one part of their family of products. They've got workshops, webinars, and seminars designed to educate you before you invest. Start with as little as $25K and finally get your money working as hard as you do. Get started at freedomfamilyinvestments.com/GRE or send a text now. It's 1-937-795-8989. Yep, text their Freedom Coach directly. Again, 1-937-795-8989. The same place where I get my own mortgage loans is where you can get yours, Ridge Lending Group, NMLS 42056. They provided our listeners with more loans than anyone because they specialize in income properties. They help you build a long-term plan for growing your real estate empire with leverage. Start your pre-qual and even chat with President Chaley Ridge personally. While it's on your mind, start at ridgelendinggroup.com. That's ridgelendinggroup.com.
This is Entrepreneur on Fire's John Lee Dumas. Don't follow money. Make money follow you with Get Rich Education.
We have a familiar voice back on the show. It's an in-house discussion here with our own GRE Investment Coach. And like I've told you before, he's got both the formal education with his MBA and the self-education because he's an active real estate investor. For 4 years now, he has helped you completely free, usually over the phone, sometimes on Zoom. He learns your own personal goals and then helps you find the market that's right for you in fitting those goals. And I've had listeners like you tell me that, I can't believe that getting his actionable insight is free. And now he can help you best, though, if you're ready to own more income property. He even helps connect you with the exact property address, like, say, 321 Raspberry Street in Huntsville, Alabama. So it's great to welcome back to the show and provide the listener with a respite from my mouth-breathing rhetoric and discourse. It is GRE Investment Coach, Naresh Vissa.
Thanks a lot, Keith. I can't believe it's been 4 years. It's been 4 amazing years. And congratulations to you and to GRE for being around so long. And together, we have grown our listenership, and we appreciate all of you listeners listening out there for sure.
Real estate activity has slowed down overall, but things are still really vibrant here at GRE. We see more activity than we saw last year. And when we talk about increasing activity, Naresh, the Fed looks to do that when they reduce interest rates. That incentivizes businesses to borrow. That incentivizes consumers to spend because, for example, they're not getting as high of a yield in their savings account. So now that we're here in this Fed cutting cycle, tell us what that means from your perspective.
We talked about this a few months ago when I was on the podcast at the Federal Reserve. I predicted that the Federal Reserve would begin a rate cutting cycle and that this cycle would be extensive. It would not be an overnight 100 basis point cut or anything like that we saw in March. So that rate cutting cycle has begun. And they continue to cut. And we did an entire episode on President Trump and the name calling with Federal Reserve Chair Jerome Powell, whose term ends in the middle of next year. It's May of next year when he's leaving. And with all that pressure, I predicted that the Fed would begin its rate cutting cycle. We are in that cutting cycle right now. They did a few cuts last year and stopped, which I thought were mistakes. But with that being said, we are in the thick of this cutting cycle. We are going to see more cuts moving forward. And what that means, you're already seeing it as a real estate investor. You are seeing, I don't want to say low interest rates, but lower interest rates compared to where we were a year ago, compared to where we were certainly 2, 3, 4 years ago. Well, maybe not 4 years ago, but 3 years ago. We are seeing far lower interest rates, and we will continue to see interest rates in the sense of mortgage rates plummet as a result of this. So enjoy the low rates while they last, because they're not going to last forever. Nothing lasts forever. But the Federal Reserve, you throw in the government shutdown, I think it makes sense that the Federal Reserve continues to cut because there's no telling where inflation is going to go. The experts thought that inflation would go up, 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 up and be a significant problem. They've been saying that since the election winter last year or the election night last year. We haven't necessarily seen that. We have seen inflation somewhat go up, but we haven't seen that runaway inflation that many of the experts predicted as a result of the tariffs, as a result of the rate cutting. I think it definitely helps that, number one, Doge cut several government programs and cut a lot of government spending, not as much as they thought they would, but they cut enough to where they're limiting the amount of federal government spending. We've also seen mass layoffs in the public sector, which has seeped into the private sector as well. Because many of these private companies, like an Accenture, for example, many of these tech companies that were getting subsidies from the government, that funding has stopped, and that has led to layoffs. Now, what layoffs do is layoffs create, I don't want to say deflation, but layoffs are disinflationary.
Right.
And we've seen significant layoffs, like I said, since February of earlier this year when Doge was in the thick. This government shutdown has led to mass layoffs as well. So we've seen tens of thousands of people, well, we've seen hundreds of thousands of people furloughed, if not at least 1 million people furloughed. Now, they will end up getting their pay, but we've seen tens of thousands of people laid off as a result of this government shutdown. And what that means is, again, this is very disinflationary. That's less money that the government is spending moving forward, not just right now, but moving forward. So there's a savings there. That's also more people who are probably going to hold on to their cash as tightly as possible as they find new work. So this is, once again, disinflationary. And what does all this mean? All of this, to me, seems disinflationary. It goes against the narrative that when you cut interest rates, inflation goes up. It goes against the narrative that when you implement tariffs, inflation goes up. And that's why we haven't seen the runaway inflation that many so-called experts were predicting. I think moving forward, the Fed continues to cut because of the weakness, at least when it comes to the job situation, because of the weakness with jobs, because of unemployment. It's gone up somewhat. I think the Fed ends up continuing their rate cutting cycle through the end of Powell's term. And it could be just a series of 25 basis points every time they meet. Maybe if there's something that they don't like, they up it to 50 basis points at one of the meetings. But the bottom line is I think they're just going to keep cutting until Powell is gone. And then Trump will put in his guy into the Fed chair. And by that point, we may have cut enough to where there's not much left to cut yet. And that's when we're going to see, there's a chance that could happen, or there's a chance the next guy will pick up where Powell left off and do a series of cuts as well. But what that means is that mortgage rates, we can expect, that's one of the most common questions I get from GRE followers.
Yeah.
It's, where do you see mortgage rates going? Because these people, a lot of our followers, they're not following the intricacies of the market. Most of our followers have full-time jobs as doctors or dentists or engineers or IT workers, and they're not following the ins and outs. And so the most common question that I get is, where are interest rates going? And I've been pretty spot on for the past few years. minus a few mistakes that I thought the Fed made. But I'm very confident when I say, just like I said when I came on earlier this year, that interest rates are on their way down. They are not on their way up.
Just wait until this administration gets their guy in as the Fed chair. It almost feels like we're going to see a Javier Milei, Argentina's president, coming in with the chainsaw. They want to cut rates so aggressively. This administration and Jerome Powell has sort of been a buffer against that. And Naresh has been using the term disinflation. And I don't want you, the listener, to confuse that with deflation. Deflation means an increase in the purchasing power of your dollar, something that we rarely see. Disinflation means a slowing in price increases, meaning the rate of inflation goes down. And yes, I think it's been pretty obvious, and I've stated on the show before as well, that the Fed cares more about the employment situation than they do the inflation situation, probably. And you as an investor, you need to be careful what you wish for, because low rates sound really good, and they can be, but high employment typically correlates with high interest rates of all types, and lower employment typically correlates with low rates of all types. Rates get lowered because they know that the economy needs the help. So you can't get both. You can't get both high employment and low rates. That condition doesn't persist for very long. And Naresh, during this part of the cycle, it's really been unusual and interesting at how new build properties have such advantages for investors today, including the aberration that the median new build property costs $33,500 less than the median existing property. That data is per the NAR. When we think about new build property, well, wait, first of all, that sounds amazing. And some people are incredulous about that, but there are reasons that the average new build property costs less. A lot of times the size is smaller. A lot of builders are building further from city centers. So I think before an investor gets in and buys a new build property, like one really important question for them to ask is, well, how far is that property from an employment center? But otherwise, it's really the right time in the cycle for new build. New build can make your investment more passive. You've got new fixtures, of course, and a warranty, and you're going to have lower insurance costs as well, typically, on a new build property. And Naresh, as you're talking with our followers and investors about new build property, I'm just kind of wondering, do you get more people that want to self-manage the property because it's new build, because they figured that their maintenance and repair requests are going to be fewer? Or what are you seeing there?
No, not at all, because the strength of GRE is that we connect investors, we coach investors so that they can own real estate around the country. They're not owning real estate in their neighborhood or in the area that they live in. We only focus on markets that make sense, generally linear markets, state-friendly, landlord-friendly states. Those are the markets we are focusing on. So even with new builds, we are seeing, I would say 100% of investors saying, hey, I want professional property manager managing the property. That's extremely, extremely common. That is the norm. I will also say with new builds, you brought up earlier when you introduced me, I own several properties. The last 2 properties I bought were new construction, were new builds.
Yeah.
And I personally, comparing the first 6 properties of rehabs to my last 2, which were new builds, I've had far fewer issues with the new builds. Not just far fewer issues. I would say overall, the profitability has been greater with the new builds, despite the pro forma initially showing that I would barely break even. Now, I did buy several years ago before all this appreciation and inflation hit, but it certainly helped a lot to have new builds where the maintenance is far lower and where the quality of the tenant is extremely high. So I generally recommend our investors, if you have the capital available, and generally, just to keep things simple, I say if you have $100,000 in liquid cash ready to go, there's no reason why you shouldn't be buying a new build. Would I waste my time with the rehabs, with the burrs? I mean, those could be profitable too. You should never say no to anything, but the new builds, I've slept better at night because of those reasons. Because I know, at least for the first 10 years, that there aren't going to be any major problems. and the quality of the tenant is going to be far higher. Right. So I'm a huge fan of new builds, not pre-construction. Pre-construction means you're buying a plot of land and then you hope that the builder is going to build a home on top of it. And most of the time the builder does, but many times, as we saw during the pandemic, there were countless stories around the country of developers selling pre-construction and then nothing ever got built. They ended up flipping the land and generating a profit off of it. I don't recommend those at all, but new construction is the way to go. And I'll also add one more tidbit about the previous topic that we talked about regarding interest rates. Also remember that lower interest rates mean that the government and their debt, they're going to be paying, they can refinance their debt and pay lower interest on their debt when interest rates go down. So that's also going to help reduce the deficit, and it's going to help reduce the debt as well. So that will help bring inflation down.
We're talking about buying a property that's already built with new construction. And in a lot of cases, like we'll talk about shortly, it's already tenanted for you as well. So it really reduces the guesswork and the waiting. And of course, new build properties tend to appreciate better than existing properties. So yeah, tell us more about new build properties, because they tend to be in Florida and Texas. That really has an outsized number of them right now. And that's where the builders are really giving incentives. And we talk about appreciation and where we think about appreciation going in the future. Appreciation has been really tepid, really boring. Prices have even contracted a little in some Florida and Texas submarkets. But with the long-term trend, Visual Capitalist just shared a terrific map. From today to 2050, for example, the Texas population is expected to grow 27%, one of the fastest growth states that there is going to be. And a lot of people say, oh, isn't it going to pass California in population soon? No, not anytime soon. It'll be decades. California is expected to grow 8% over the next 25 years. But Texas is a place where the numbers still can make sense on new build because you have some overbuilding. So some builders are really incentivized to give you a good deal.
Well, there are several markets in general. Let's just talk about it. You use an important term, which is appreciation. With new builds, the likelihood of appreciation is greater. This is statistically backed up. You can go check your sources, but the likelihood of appreciation is far greater with new builds compared to older rehabs, a property that's 50 years old, 60 years old. In fact, those properties probably appreciated early on in their life cycle. And that's just generally how it works. So with new builds, I say, look, cash flow is still important. Cash flow is one of the tenets of real estate paying five ways. It's one of the core tenets of get rich education. But you also have that appreciation play with new builds. Again, it's about markets, because if you're buying a new build in, let's say, a California or in New York or in New Hampshire, really anywhere in the Northeast, then it is somewhat of a speculative play, depending on the price point, depending on a lot of different other factors. But when you're talking about the markets that we operate in at GRE, you brought up two of them, Florida and Texas. There are other markets like in Tennessee and Oklahoma where we have new constructions, and they are also positive cash flowing, high appreciation plays. So you just never know what's going to happen. I bought a new construction, for example, just outside of Memphis 6 years ago. It was just outside of Memphis in Mississippi 6 years ago. And I bought it for purely cash flow purposes. The pro forma looked good. Property was brand new. It was near several areas where there were many jobs. So I said, hey, this is a good cash flow play. And I even remember asking my sales agent, hey, what do you think about appreciation? I usually never buy for appreciation, but this is a new construction. What do you think? And he said, you know what? I don't know if this is really going to appreciate that much. I'm not really sure about that. So I said, that's fine. I like the cash flow. Well, fast forward 6 years later, as I said, you just never know what's going to happen. We saw this inflation. We also saw an influx of people migrating into Tennessee, migrating into Mississippi, especially that Mississippi-Tennessee border, migrating into the Memphis area. Now we have the Trump administration sent in the National Guard, or about a month ago, sent in the National Guard into the Memphis area. and they haven't left. They're still there. And is, at least based on the numbers, that crime has really, the National Guard has made a big difference on crime. And that's usually the number one deterrent for a market like Memphis. The point that I'm making here is that you just never know what's going to happen with these new construction builds. If you can get positive cash flow, I always tell our listeners, you shouldn't buy a new construction that's negatively cash flowing. You still want to protect yourself. You don't want to be paying money out of your bank account to own a property. Money should be coming in. So you still want to be positive cash flow. And the appreciation is a huge, huge plus, even in areas that you would not think or that you would not expect to appreciate all that much.
Appreciation just is not as much of a story over on some other platforms, perhaps, or the way that people think about it. Because if you pay all cash, appreciation isn't that good for you. But you're leveraged at 4-to-1 or 5-to-1 with a 20 to 25% down payment, which can really give you those outsized rates of return, which aligns with what we talk about here at GRE. Well, we have a live upcoming virtual event. It is this coming Thursday. And before I ask you if you have anything else to tell the audience here as we wrap up, Naresh, it is hosted by you. So it is co-hosted by our own in-house investment coach, Naresh, and our guest that you heard last week here on the show, radio veteran Adam. The event Thursday is called How to Scale Your Portfolio with Tenanted Cash Flowing New Construction Properties, where you can get up to $41,000 cash back after closing. We talk about these builder incentives. So today's real estate market is really giving buyers opportunities for new builds that I haven't seen maybe ever. Builders are incentivized to move their properties, and we've made headway with builders to get you up to a 10% cash back incentive at closing. When you purchase, you can either take the cash at closing or boost your cash flow by buying down your rate, perhaps get some rent credits. So learn how you can take advantage and really prime yourselves for moves today that are going to lead to your success in coming years. And we have tenanted, already occupied new build properties in hot markets like Houston, San Antonio, Dallas, Texas, ready for you to purchase with up to that 10% builder incentive so that you can cash flow from day one. And these properties are really in high quality communities, primarily owner occupied, high appreciation upside, solid rent growth. So learn the strategy, learn the markets, and even see available new build income property. The benefit of you attending is that you can have your questions answered in real time by Naresh or Adam. You can sign up for that now at grewebinars.com. It is Thursday, November 13th at 8 p.m. Eastern. Any last thoughts as we lead into Thursday, Naresh?
GREwebinars.com, GREwebinars.com. Go to that website to register for our free online special event. It will be live. I'm going to be there with Adam. You heard on last week's podcast, we've got some great deals, great incentives, like what you said, Keith. And they're all new constructions. They're all new constructions, mostly in Texas. And these are major markets in Texas, too. We're not talking...
Yeah.
Many of our followers and listeners, they see a new construction and they're like, I've never heard of this place in Alabama, or I've never heard of this place in Oklahoma. These are in legitimate suburbs, areas outside of Dallas, Houston, San Antonio. Some of them are even in Dallas, Houston, San Antonio proper. So these are markets that everybody is familiar with. It's not some podunk town that you may have seen on our GRE marketplace or GRE spreadsheet in an Arkansas or in Alabama. These are mostly in Texas. The incentives are great. And these are national builders as well. These are not small, no-name mom and pop builders. These are national builders who we are working with to offer these special incentives. These are names like you've heard. Many people have heard. Some of them are publicly traded companies like an LGI. That's a very large national builder. That's who we've partnered with to get these deals. So grewebinars.com is the link to register for our online special event, grewebinars.com. I hope to see all of you this Thursday.
Major builders, major markets, and major incentives on new build property. You're going to hear more from Naresh on Thursday. It's been great having you back on the show.
Thanks a lot, Keith.
Oh yeah, Naresh does a better job of hosting GRE webinars than I do, in my opinion. You'll remember that I hosted them myself until 2023, but maybe I'll come on to a future event for just the first 5 minutes on one of the upcoming ones and give an intro before I let the real pros take over. This event is called really just what it is: how to scale your portfolio with tenanted cash flowing new construction properties. It's co-hosted by Naresh and Adam, who you met last week. I have never seen this before, where the builder is giving you a fat 10% discount after closing. 10%. You can use those tens of thousands of dollars to buy your rate down into the 4s, or other things like use it toward a down payment on another property, pair it with DSCR loans, and pay no mortgage insurance on either property. You could buy one property or 2 properties or 18 properties through the event. And DSCR loans, you might remember, that means no time-consuming income verification, no concerns about your debt-to-income ratio or W-2s or tax returns. We'll show you how to do it all. Like Naresh was saying, we eat our own cooking. We ourselves here at GRE are investors too, and we are buying new build for our own personal portfolios. The time is right for this. It wasn't a few years ago, and a few years from now, it probably won't be either. Hundreds are already signed up for it. It is this Thursday at 8 p.m. Eastern. It's GRE's last event of the year. This is it. One last time. Attend by signing up at grewebinars.com. That's grewebinars.com. Until next week, I'm your host, Keith Weinhold. Don't quit your daydream.
Nothing on this show should be considered specific, personal, or professional advice. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions of guests are their own. Information is not guaranteed. All investment strategies have the potential for profit or loss. The host is operating on behalf of Get Rich Education, LLC exclusively.
The preceding program was brought to you by your home for wealth building, GetRichEducation.com.